Hi, it's Payam here from Niche Advice. I thought I'll talk to you about bridging finance and different aspects of bridging finance. We're getting more and more bridging inquiries as a business, and there are big differences in bridging. And I'm aware that there is a lot of choice out there, and there's a lot of online content on bridging. So I thought I'll just explain some of the few points that are really important, because unfortunately I'm getting a lot of inquiries where clients have approached lenders direct on bridging and are not aware of some of the big consequences that may affect them when they're trying to place a deal, or more importantly when they're trying to exit out of a bridging deal. It's very easy to get into something, it's much harder to get out of something. So we're going to focus on that. First of all, when it comes to bridging finance, there are two types of bridging finance. There's a regulated bridge and there's an unregulated bridge. What a regulated bridge is basically you've got more consumer protection and it's regulated by the Financial Conduct Authority. What that means is generally is either you or your family have lived in that property or plot, or you've inherited the property without having the sort of relevant commercial experience. So generally, I mean, there are more aspects to a regulated deal, but you know, if you've lived in the property and you're looking to convert the property maybe into something else, or you've inherited a property and you don't own any other buy-to-lets, generally that's seen as a regulated deal. Now, a regulated deal has more consumer protection because it's essentially regulated by the Financial Conduct Authority. There's greater care needs to be given over the advice process as well as the lending process. So it's better for the consumer, but there's a lot more documentation involved. There's greater scrutiny in regards to affordability and how that deal is going to be financed and how that deal is going to be repaid. So generally what you'll find is a lot of the lenders will drop their loan to values on consumer regulated sort of bridging finance deals. So it's very, very important. That's a really important deal. So a broker needs to understand what the impact of getting a regulated deal is. First of all, a lot of the bridging brokers out there are not regulated, so they can't actually deal with regulated deals. Regulated deals generally means a lot of the residential mortgage brokers that could do residential mortgages and buy-to-lets, they can generally do regulated deals. Some of the commercial brokers out there will not be able to, they don't have the right permissions to advise on regulated deal. Niche Advice Limited, we're fully regulated, which means we actually do residential mortgages, buy-to-let, as well as regulated bridges and unregulated deals. So we can do the whole batch really. But what I've got is, what I get quite a lot of inquiries is borderline, is it regulated, is it not regulated? And if in doubt, I tend to go down the side of caution and speak to the lenders and see what their views are, and try to see what we can do for the clients. So that's a regulated side. Then you've got the non-regulated. Non-regulated essentially means it's a commercial deal. So it's a buy-to-let deal. It's a development deal. You haven't lived in there. You don't have any interest personally in that property in terms of living there or family members living there or so forth. So it's a purely commercial transaction. It's for business purposes, okay? And what you will find is generally, let's say there's 6 or 7 lenders doing regulated bridging deals. There's probably 30, 40 lenders doing, probably more, non-regulated bridging deals. So that's the bigger market, and that's where a lot of the lending is being done at the moment in bridging. And that's where essentially some of the problems arise in the non-regulated market, because they're dealing with brokers maybe that are not as transparent, let's say, than they should be, because they're not fully regulated by an organization. So for our purposes, we pretty much treat both deals the same. Okay, we'll ask for the same level of documentation, we'll ask for the same level of scrutiny, same level of underwriting. So we'll treat the deal pretty much the same, where when you're dealing with others, they may not see that. And one of the biggest problems where things fall out is not getting into the deal. Like I said, a lot of bridging is all about equity based. Okay, at the end of the day, bridging finance is a short-term finance to fund something, whether that's a conversion, whether it's a tax bill, whether it's a short-term medium, whether it's a development deal. And so you need X amount of funds to do this for 6 months, 12 months, auction finance, whatever it is, okay? But after that, you need to get out, because bridging finance is not cheap, it's expensive. It can start from, I don't know, 0.45% a month, right the way through to 2%, okay? So, and the differentiator between that is your profile, level of equity, adverse credit, what you're trying to do, what is the asset. So all of those things will determine whether it's going to be a cheap deal or it's going to be a more expensive deal, okay? But bottom line is it's expensive, okay? So it's not something that you want to be sitting on for a long time. So whatever you're doing, there needs to be a plan. Okay, I'm getting into this deal. It's going to, say it's I don't know, it's a conversion. I'm buying this property. It's going to take 3 months for me to develop it. I want to be out, whether I'm going to sell it in 6 months' time or I'm going to refinance it. We need to be clear. What is your plan? What is your exit? Oh, if it's refinance, okay, how are you going to refinance that? Have you got buy-to-let experience? Have you got, have you got the income profile, for example, credit profile? Is that a viable option for us to get out? And these are the conversations, unfortunately, that are not being had. People are just taking the money and going. You know, they're just worried about the bridging finance. Okay, oh, I'm just the bridging broker. I'll take the bridge, and this is what you wanted. You've got this at the end of the day. But that's not really a sensible way to go about things. What you want to do is find out what the bridge is. Find out what the solution is, but also think about the exit, okay? Now, what I'm finding is, and when I get calls, is a lot of people, their exit was sale, but then they only did that really to tell the lender that, to make it easy, but they really want to refinance. But they're not in a position to refinance because the original broker was a bridging broker. They didn't actually understand the buy-to-let exit side of things or the residential side of things, okay, if it was going to be their main residential home. So they don't know the criteria on the mortgage front, okay? So it makes things very difficult, because if you've got an exit strategy which is not really realistic, then you're stuck with that asset, paying 1% a month, 0.85% a month. So it can be very, very expensive. And I get calls all the time where people are stuck on bridging finance. And you know what? When you start going over your term, then penalties start happening in terms of the bridging lenders start putting penalties on, hiking your rates on, asking you to pay the fees up front, pay the repayments up front. So exit strategy is vital. Understanding the viable exit strategy is vital. Giving enough time for that exit strategy. If it's sale, well, are you going to sell the house in 2 months? Well, why don't you do it, maybe if you think you're going to be done in 6 months, put the bridge for 12 months, okay? Most bridging finances at the moment, after a month, they tend to have no early repayment charges anyway. There are some that do, but again, it's understanding when are you going to get out? What are you going to do? Is it refinance? Is it redevelopment? Is it getting a commercial mortgage? Is it a buy-to-let mortgage? So we get that right. And then we look at the fees involved with bridging finance. Generally, like I said, the solicitor fees, the survey fees, they're a lot more higher than a normal mortgage. So, and again, when you're dealing with people that have not dealt with this type of market before, you start talking about the fees. Oh no, I can't pay that. Well, do you know what? You need to know about this stuff now, because otherwise you're going to get yourself in trouble. Okay, and so really, from a bridging perspective, talking to the right people and understanding how bridging will affect you is really important. It's okay if you're an experienced developer, you know how it works, you know how to exit it. But a lot of people are coming into it, especially listening to seminars out there and saying, well, buy it on a bridge, and then you can refinance it, pull your equity out and buy other properties. That is a viable option, but there are some important factors out there. For example, if you're buying a property, let's just assume you're buying a property in auction. You buy it for a bridging, and let's say you get 70% or even 75% on an auction value. You do up the property, say you spend £30,000 on that property. Now you want to get it on a higher value, okay? A lot of the lenders out there have got a remortgage 6 months rule, okay? So what that means is you can't remortgage that property within 6 months and get the higher value. Now, there are lots of other lenders that will say, yes, we'll allow you to remortgage the property, Okay, but because it's within 6 months, we'll only do it on the valuation that you paid for the property. Then there are some lenders that will say, okay, because it's within 6 months, we'll allow you to, we'll let you do it for what you paid for it. But let's say you spent 30K. If you can prove you spent 30K on it, then we'll allow you to take that equity out. Then there are some lenders that will say, right, we will allow you to take what it is on the open market because we can see you bought the property and we can see what you did. Now, all of those options are there. The rates are different. The fees are different. And that's important. So if you want to do that, that's fine. But you've got to understand that sometimes it might be better to wait 6 months and get it at a much better rate because you might be tied into that deal for 5 years. So it's speaking to your broker, letting them know what your long-term strategy is. What are you thinking of doing? Are you thinking of building a portfolio out of this? If so, then it may be worth staying for another 2 months on that bridge and then doing it on a long-term fix on a better rate for 5 years, rather than doing it very, very quickly, taking your equity out, being stuck on a exit strategy on a buy-to-let or a commercial lender, which is not that competitive. And then what will happen is, if there's a downturn in the future, you're stuck with that deal. So exit strategies again come into place, but certainly what you're doing with that asset and how you're bridging that's important. When you're talking about bridging also, a lot of the lenders want to lend. Brokers want to do the deal. What I find the problem area is legals. Legals is an absolute pain, okay? Because essentially there's greater scrutiny of the deal being done through the solicitors. So what a lot of the lenders tend to do is almost outsource a lot of that underwriting, a lot of scrutiny to the solicitors. So if it's a purchase, there's great scrutiny done under, for example, of the client, certainly around the funds, the deposit funds. Where did it come from? Where did you get this money? How did it come to me? Where are you using it? Did you sell an asset? Show us proof of that asset. So there's greater scrutiny done on a legal stage, a lot more than in your traditional buy-to-let mortgage or residential. And a lot of deals, you know, tend to go from broker to lender to valuation to mortgage offer really quickly. And then things get bogged down on solicitor stages, okay? Also on bridging finance, to be honest with you, the broker can say what they want to say. I can tell you what I can say. The lender will give you all the terms they want. Nothing's really done until the valuation takes place. So you've got to commit, you've got to pay your money, and you've got to get valuation. And in this market, I can tell you now, things are down valuing all the time. Okay? So if you think your property is worth 400, it's going to down value. Okay? So be prepared for down valuations. Okay? Leave the margin. Have that discussion with your broker. What happens if you're looking to raise 75% or 70%? What happens if it down values? You know, you don't want to waste your money. Can you still make it work? Have you still got enough margin there? Because the likelihood are in this market, especially with bridging finance, I find things down value more. And I'm just being truthful. They do down value. So it's not so much a problem if you're purchasing, because then you can have a conversation with the people you're buying from and say, look, you know, I've had a survey done, it's down value. More of a problem when you're trying to refinance things, okay? So we'll do a bridge to bridge, or however you're trying to do this. So be mindful of down valuations, and be mindful that whatever the broker says, whatever the lender says, valuation's king, equity is king when it comes to bridging, because ultimately they are securing it under the asset. So if there's something wrong, they want to repossess you. Okay, essentially they would want to secure that if there's any problems, they want to go after that asset. So that asset means a lot, and that's why greater scrutiny is always done on the valuation. That's why it's more expensive. The valuation reports are a lot more expensive because they're a lot more detailed. They're asking a lot more of the surveyors, okay, because they want to make sure if things go wrong, they can come after the assets. Okay, and this brings me nicely to a point of, there are a lot of lenders out there. There are some very good, very reputable, and there are some that are not very good and not very reputable. And essentially they're lending to you because they've got the eye on your asset. Okay, so when you see things that are too good to be true, they generally are, okay, not. So what you want to do is if you can, always try to go with a reputable lender. Every deal's different. We'll try to do, if it's a regulated deal, I always like to go with a bank if I can, okay? Because a bank will give you a greater reassurance if there's any problems with the case. You're there, you're with a bank, okay? Rather than a small private lender, okay? Now, there are certain things that the banks will not do. If it's got commercial elements, sometimes they don't like them. If it's got adverse credit, they don't like them. So if it's a little bit quirky, the property's a bit different, they don't like them. So there are reasons why you would go to tier 1, tier 2, tier 3 lenders, type of lenders. But you'd go down that route, or you would go with lenders that have got a good track record of lending within that sector. So, if it's a pub conversion, there's a certain lender for that. If it's a development finance, there are certain lenders for that. So, and that's the job of a broker, really, to understand what you're looking for and which lenders best suit the model. And I'm never one to just lend on pricing. I get calls from clients that say, well, no, so-and-so is giving me 0.49. Why have you given me 0.65? I say, well, I like the lender. I think the lender will do the deal. And ultimately, that's what it's all about. What would happen if, you've got to take into account that we've got history. Bridging deals never go to plan, okay? Hardly ever go to the plan. So sometimes they need to be extended. How does the lender treat you if you've gone over your plan? How does that lender turn around the case? It's all great saying 0.45. However, if they're going to take 2 months to give you the money, you've lost the deal, or it's cost you more. So it's about putting together the broker's knowledge, the lender's criteria, and your needs, okay? So pricing is not always king. It's doability, it's what they were willing to do, it's the underwriter's flexibility, it's how they deal with unexpected things. How do they deal with down valuations, for example? What's the margin? Do they just knock you off at 65%? Have they got a leeway to go to 70% loan to value if it's down valued? Or do you have to start all over again? So that's important when it comes to bridging. That's about it, really. I mean, exit strategies in bridging is a whole different topic as well. We'll talk about, hopefully we can talk about in the next videos about some of the exits that we can do on bridging, whether it's buy-to-let, whether it's semi-commercial or commercial exits out there. But be wary, there's lots of bridging lenders out there. There are lots of bridging brokers out there. Everybody wants the right business, but it's very, very important you understand what you're getting into. You do not want to get yourself into a pickle whereby, you're stuck with an asset there. It's so important you understand the exit strategy. I have to reiterate, because I do get calls on this all the time. Do not be fooled by an agreement in principle from a lender. Agreement in principle from a lender does not take into account a lot of things. They just, often they just run a basic affordability as well as a credit check. So get it checked out. Get it checked out by the right people. And yeah, visit us at nicheadvice.co.uk. Please hit the like button if you did like what I've said, and hit the bell icon to get notifications. Thank you so much. Appreciate it.